Okay, we are recording. Welcome everyone to our virtual lunch and learn. Today we have Tanner Withers with Albility Planning, and he has so much information that we're going to talk about today about planning for your family's future and a very great future. Tanner is also a member of United Angels Foundation, and I work with Tanner on Utah's Rare Disease Advisory Council. One thing that I really enjoy learning from Tanner is I always learn something new from him. So even if you've done a webinar with us before about special needs planning, I think you will learn something new. Also, if you have questions that are simple or basic or complicated, Tanner is an amazing detective, and he will find out the answer for you and find out everything you need to know about that. So I'm so excited that Tanner is here. Thank you for presenting today, Tanner, and I'm going to turn it over to you.
Awesome. Thank you, Sylvia. I'm going to get my screen shared. I've got kind of a different setup than I've had in the past. Does that look okay?
Yes.
Okay, perfect. Sylvia, maybe if you would, just for a quick minute here to start, I shared this with my network too, and a lot of those folks may be outside of Utah and not already affiliated with United Angels. Could you just give maybe a quick blurb on what you guys do for those who don't know what you do?
Absolutely. United Angels Foundation supports parents and families of individuals with special needs. Our whole goal is to empower parents for life planning. And we do this through education, like today's Lunch and Learn, sharing resources, and building community. We have a lot of events where we build our special needs community so our families can get connected with other families who are on the same journey, can support one another, and build a community that is going to be inclusive and also incorporate the greater community, which is amazing. We have programs and services from birth and diagnosis all the way through the transition to adulthood. If you would like to learn more, membership is free. There's no cost to join. You can go to our website, unitedangels.org, and sign up for our email list. One of our staff members will contact you, and we can do an onboarding orientation call with you, find out more about your family, and then we can direct you to the specific programs and services that we have available that would be most beneficial to you and your family.
Awesome. Thank you so much, Sylvia. Like I said, I imagine a number of you maybe are coming from just either social media platforms or other places and maybe didn't know about United Angels. So it's been my pleasure to work with Sylvia as well over the past many years. So I appreciate all you guys do. Let me kick this off here. And I'll start off by doing a quick introduction of myself, my background, why I do this, how this works, and then we'll dive into our topics for today. Um, I'm a parent first and foremost. These are my two little girls, and they're the reason that I do this. I actually started in this industry doing financial planning and investment management. Worked for a number of larger firms, and after a few years of doing that, I realized that I didn't kind of like the corporate world. It wasn't exactly what I was looking for, so I left and I started my own financial planning and investment management company. Didn't really have an ideal client or niche or anybody. It was just whoever needed it, whenever it worked. At about the same time, my wife and I were approached by a nonprofit organization, and they said, "Hey, we are headed down to Colombia, and we're going to find kids in orphanages that need to be adopted. And most of these kids have a disability. Is that something that you guys would be interested in?" And sure enough, adopting a child with a disability was something my wife and I had always discussed. We just had no clue when that would happen. And we already had one daughter at the time, our little redhead, my little mini me here. And when they came knocking on our door, we said, okay, I guess this is what we're doing next. And so we committed to the process, and they found our second little girl here. Her name is Halcyon. And we just instantly fell in love with her. And as we started reading through her charts in the adoption process, that's where we read about her diagnosis, which is a rare disease. Looks a lot like Down syndrome. A lot of times people think she has Down syndrome, but she doesn't. Although a lot of the symptoms and disabilities look similar to that. And as we started this process, that's where it sort of clicked for us of like, oh, wow, how do we do this? Right? We're going to have a child who's going to be dependent on us forever, will likely live with us forever. What do we do? And much like many of you who are probably on the call, you've probably had those same questions. And there's not a roadmap out there for us to know what to do. And that's where it clicked for me to say, that's what I want to do. That's what I want my career to be. And so ultimately, we built this firm, Albility Planning, to help families just like yours, just like mine, do the planning that has to be done and make sure it's done correctly. And so the key pieces that I focus on are the financial, the investments, the benefits, the estate, and the family support, and ensuring that our loved ones and us as parents, caregivers, or whatever role you fill have the best chance of life that we possibly can. So that's just kind of the quick background on us and who we are. I'm going to skip through this and I'm going to just go straight to our kind of important disclosure, and then let's kick things off. As much as I would love to give you exact specific advice on what to do, I can't do that in a group format. And so today, this is just education. Please, though, don't let that stop you from asking questions. As Sylvia mentioned, as we go about, the chat is open. And so I'd love for you to be able to jump in and ask your questions in the chat. And I'll pause periodically and review those, but you can also come off mute and ask those questions as well. The other thing I always like to just start with and lead with is I do my best to teach in crayon so that you can learn in crayon, because nothing about the disability world is simple and it changes all the time. And so as we go about, if things are a little bit more not crayony and they're looking more like a Sharpie, then just stop me and say, hey, can you explain that a little bit more? I'm not sure I understand that. The last thing I want you to do is spend an hour here and feel like you didn't understand what you got. So that's the way I always like to kind of lead off. That said, here's our topic for today: benefits, tax planning, specifically for families with disabilities. The key points that I'd like to hit on are, number one, it's tax season. We just ended tax season a couple of days ago. And some of you might have owed money. Some of you might have received a refund. And so I want to talk about, what do we do with that? How does that play into disability and special needs planning? Then I want to talk about what disability and special needs planning is. What does it look like? What are some of the key things I need you to know? The third thing that I want to hit on is going back to the taxes. How do we make your taxes optimized? How do we take some strategies to make it so that next year is a little bit of a better year if it was a bad year, or just make it better in general? And then we'll talk through a couple tax tips as we go along. Let's kick it off here by talking about kind of high level owing versus getting a refund, the difference between those things. If you get a tax refund or a tax return, it might feel exciting, but in reality, that just meant that you gave a tax-free loan to the government. And I don't know the last time the government gave us a tax-free loan. And so it just means you paid or you overpaid. You withheld too many taxes throughout the year. Again, it feels really cool to have it, but it's not actually optimal. We're going to talk through what we do if that happens, and some potential strategies we can take to change that, but also to invest for our own future. I also want to talk through, like, why do we potentially have a return? Either that means that your W-4 is wrong. And so the one thing I do want to just tell you right off the bat, if it's been a while since you've looked at your W-4 from your job, maybe you haven't looked at it since you first filed, go back and update your W-4. They come out with new W-4s every few years. And sometimes it changes drastically the way that your taxes are withheld. Also, if you have older kids and maybe they're no longer in the house, you may still be claiming them as a dependent when they're not. We'll also talk about what it looks like to depend a disabled child, a disabled adult child who maybe is on SSI. So that's just a quick one to look at there that might be wrong. You might also have more tax deductions and credits than you accounted for. So, maybe you weren't thinking you were going to have these different deductions and credits, and that's why you're getting a refund. You also maybe were planning on the standard deduction, but now you're itemizing with the, what is it called? Big Beautiful Bill, the new Trump tax law that was finalized, or I should say made permanent. The standard deduction is huge now. I think it's $32,200 for this year or something like that. A lot of people don't itemize anymore because of that, but maybe you did, right? Maybe you did itemize. Maybe your medical bills were huge. Maybe your charitable contributions were huge, and that could be a reason why you're getting a refund. It's also possible that you had a filing status change. So if any of you either got married or unmarried, divorced, separated, or anything otherwise with your tax status, that's also something that would potentially affect you getting a return. And then, of course, contributions to tax advantaged accounts. And we're going to talk about that as we go. So those are just some reasons why you might be getting a return, a tax refund, if that's what happened to you over these last couple of weeks, months. The second part of this is, why are you owing taxes? Well, owing taxes means you didn't pay enough or withhold enough throughout the year. And sometimes that could even impose penalties. In fact, my accountant this year told me, hey, you actually didn't withhold enough. So there's a little bit of some penalty on yours. And we need to rectify that for this year. So that's exactly what we did. We started withholding a little bit more. And now I hopefully won't have any penalties for next year. So that's something that even me who looks at this all day, every day, can be missed. And there's no reason to pay more money than we need to. A couple of reasons you might owe is maybe you withheld too few taxes on your W-4. So again, another reason just to go back and look at it. Maybe you have a side hustle, a side gig. Maybe you do some DoorDash or Lyft or whatever it is that you do on the side. Or maybe you have a spouse who has a side gig and that wasn't accounted for. That could be a reason that you owe. Maybe you sold investments or you sold a house. And you have capital gains that you were not expecting. That could be a reason that you owe. It's also possible that you were expecting to get certain deductions and tax credits, and you actually don't qualify for those, either due to income or just the deductions didn't happen. And so that could be another reason. Filing status changes, again, we already talked about that one. And another big one that I see is people who take money out of their retirement accounts and didn't realize that they needed to withhold taxes. So that's one that can potentially happen as well. Changes in tax law, that always happens each and every year. Of course, we just talked about the big, beautiful bill and some of the implications there. A big one that I see as well are bonuses. So bonuses can be taxed differently and have withholdings different than what you expected. So any of these could be reasons that you potentially owed. Hopefully you were able to pick out a couple. And again, like I said, as we go about, we're going to talk about what we do with that. Our goal, though, is this. We want to be as close to zero as possible. It's a fun game I like to play with my accountant every year. How close can I get to zero? Nothing returned, nothing owed. And we're going to talk about some things at the end that you might be able to do to make that possible and to understand where you're at. There's a really cool tool. Very rarely government websites are helpful, but the IRS actually has a super cool tool that I use all the time that you can use, and I'll show you exactly how it works, where you can see if you're on track. We're already here in almost May, where we're nearing our halfway through point through the year. You can see if you're on track to get a refund or if you're on track to owe. And you can change it, and it will actually tell you exactly what to change. So that's really cool. So hang on to the end to see that tool. But here's the whole point, guys. I'm not here to harp on taxes necessarily. Tax season is a great time to consider your long-term disability and special needs plan. And the reason is because you're already thinking about your money. There are 2 times I've found that we tend to think about money proactively. The rest of the time we do our best to not think about it. Unless you're me, you can ask my wife. I talk about it all the time. It drives her nuts. We tend to think about money in January when we're super motivated and we want to create new goals for ourselves to be better. And we tend to think about it during tax season. And like I said, beyond those times, it's usually not top of mind unless we're spending. Because of that, Sylvia brought up the great idea of saying, hey, let's take advantage of the fact that people are thinking about their finances and ways that we can use tax season to benefit our long-term plan and our long-term need. And that's what I want to talk about next. This is going to be kind of the key point here. I've always said this for those of you who have heard me present before or maybe heard me talk on my social media channels. Disability and special needs planning is all about taking advantage of every single publicly available benefit while never becoming dependent on them. And I don't need to tell you why, right? We see this happening in the state of Utah, throughout the country, where these benefits are under a lot of pressure to change, to go away, to be reduced. And every time we have new legislation, they could always be on the chopping block. And so while they're there, you betcha, we're going to take advantage of them, every last one of them. You're paying for it in taxes, so you might as well get it back. but we're never going to build a plan that means your child or your loved one with a disability is only going to be okay if they get these benefits, because that's not a great plan at all. The other thing I want to throw out there, in case any of you are in the fortunate situation where you're thinking, hey, I have a lot of resources, either through a job, savings, investments, inheritance, whatever it is. Is it even worth going through the effort of getting these public benefits? That's a valid question. And I would answer it in the affirmative to say, yes, it is. And the reason for that is because a lot of benefits, a lot of supports, a lot of programs that your child might need may not accept private pay. They may only accept Medicaid funding. And so we always want to do our best to be Medicaid eligible. And though it's a pain in the butt, the whole purpose of what I'm going to share with you today are ways to make this better. And when we know the rules, it doesn't feel as cumbersome. That's kind of the hope and the idea there. So let's talk about the three different kinds of government benefits. This is what makes planning unique when you have a loved one with a disability. The first kind of benefit is going to be an income benefit, and there are two key. The first is SSI, which is supplemental security income. And the second is SSDI, which is Social Security Disability Insurance. It's very easy to mix those up because they're only one letter apart, but they do very, very different things. And I'm going to explain what they do and how they work. The SSDI is going to be the main thing that I want to focus on today because that's the highest paying benefit. And I want your loved ones to get the most amount of money they can get. The second kind of government benefit is going to be insurance, specifically Medicaid and Medicare. So we're talking about health insurance. Medicaid typically goes with SSI. Medicare typically goes with SSDI. And then the last type of government benefit are going to be supports, things like Medicaid waivers. We also call those HCBS, or home-based community and supports waivers. We have SNAP, or food stamps. We have caregiver compensation, and we have housing vouchers like Section 8 housing vouchers. As I mentioned, I'm going to take the most of our time today and really kind of talk through the SSDI, specifically the DAC benefit, but know that these other benefits are very much applicable. And in my opinion, the most valuable benefit is Medicaid. Medicaid also conveniently has the most strict eligibility requirements. So if we qualify for that, we're probably going to qualify for everything else. But to kick this off, I want to kind of get you excited about this. Let's talk about the $1 million difference. I want to introduce two scenarios here about how much of a difference Social Security alone can make. Nobody gets so excited about Social Security, and especially not now, because you hear all day long about how Social Security is going to go away or it's going to be reduced. And guess what? That is kind of true. Here's what we know. By the year 2033, unless the government fixes this, which, between you and I don't have a lot of confidence in, if they don't fix it, by the year 2033, everybody's Social Security will be reduced by 23%. So when I'm doing planning for families, I always take whatever's on their statement and I reduce it by 23%. If the government fixes it, great, but we're already planning on the reduction. So is it going away? No, it's never going to go fully and entirely away, but it will likely be reduced. But here's how much of a difference this can still make in your family's life. Here's the scenario. Let's assume we are going to plan the life cost of your disabled and dependent loved one without Social Security. So we've got to figure out how much it costs to take care of them. No disabled adult child benefit, nothing. Let's assume that their monthly expenses are going to be about $5,000 a month when you are no longer here to care and help them. By the way, $5,000 is very average. I would even say potentially low end from the planning I do with families. Think about your own life and your own budget and compare that. So $5,000 a month, that means it's $60,000 per year. Let's say that you, the parents, live another 30 years, at least. So 30 years from now, you, the parent, you pass away. That same $60,000 today is worth $145,000 a year with 3% inflation, which is kind of average inflation. Let's then assume that after you die, so you, the parent, die in 30 years, let's assume your disabled child lives another 20 years after you. We have what's called a safety withdrawal rate in finance. And that basically means how much money can we take out of our investments each year to live off of. For someone who needs to live another 20 years, we could probably very safely withdraw 5%, maybe even more. But at a 5% withdrawal rate, that means that $2.9 million is needed to cover that $60,000 a year or $5,000 a month. And the way we find that is we divide 5% divided by 145,000. Meaning, if this sounds similar to your scenario where your child might need $5,000 a month, you live another 30 years, they live another 20 years, $2.9 million is how much it would cost to take care of your disabled loved one. It's a lot of money. I don't have that in the bank. Let's compare that though to planning with Social Security. It says without, it should say with, so that's an error. This is with Social Security this time. Let's assume $2,000 a month in Social Security. That is very average. A lot of your kids may even get more. Let's assume the same monthly expenses of $5,000. That's 60 grand a year, same future. But the difference is the net expenses are only $3,000 per month or $36,000 a year. And that's because $2,000 of it is covered by Social Security. 30 years from now, assuming you live at least that long, that same 36,000 with inflation is actually going to be 87,000. We assume the same 20-year life expectancy beyond that of your disabled loved one. We do the math. Your disabled loved one needs $1.7 million at the point of your passing in order to ensure that they can live the rest of their life. If you're not good at math, I'll show you. That's a $1.2 million difference that a simple, measly $2,000 of Social Security per month can make. I share this with you because, again, there's a lot of talk about Social Security. There's a lot of talk about how much pain it is and is even worth getting. It is worth getting. Unless you have $3 million laying around and that's not going to be a problem, then sure, don't worry about it. But if you're already doing everything that you possibly can, I think it's worth $1.2 million personally. So let's talk about how we get this Social Security and what it is. What is SSI? Let's start with that. SSI stands for Supplemental Security Income. It provides needs-based monthly income payments to eligible adults who have little or no income or assets. Now, I do want to clarify something. Yes, Social Security can be paid to kids who are not adults, specifically minors under the age of 18. However, that is based off of a parent's income and assets. The income limit is about $5,000 last I checked per month. So if you have household income greater than that, your disabled child's not going to get it. If they have income less than that, then they could. I'm specifically talking about 18 plus. In the eyes of the government, they view this as welfare, meaning they're going to give you the money. There's no requirement to earn it. And they're also going to tell you how to spend the money. The eligibility requirements look like this. You must be either 65 or older, blind or disabled. We're obviously talking about disability. You must have income less than $2,073 per month, a nice even round number that none of us will forget. And you must have assets less than $2,000. An asset is anything that's not a primary home, a primary vehicle, or personal property. And in 2026, the maximum SSI payment is $994 per month. Some states offer a supplement, Utah does not, so the $994 is the maximum that we get. Let's compare and contrast this to SSDI. SSDI, in contrast, is Social Security Disability Insurance. It provides monthly payments to eligible adults who have a disability that stops or limits their ability to work. The key difference is that SSI is given freely as long as you qualify. SSDI must be earned, either by the disabled individual themselves or by a parent. That's the only way to get SSDI. In case you're curious how much SSDI pays, the maximum SSDI in 2025 was $4,000 a month. The average SSDI was about $1,500. Still more than what SSI pays. The way you qualify for SSDI is you have a disability, income less than 1,690. Yes, it's a different number than SSI, but there is no asset limit for SSDI. Instead, as I mentioned, you either must be the worker or you must be a disabled adult child. And this benefit is the benefit I want you to be able to know about because it provides that extra income that you need that makes the $1.2 million difference. Let me introduce that, and then we're going to pause and we'll answer some questions. The disabled adult child benefit is sometimes called the childhood disability benefit. I like to call it the DAC. That seems to be what Social Security is calling it more these days. It's based off of a parent's Social Security, either through the parent's retirement Social Security, if the parent is disabled themselves, or if the parent has passed away. That is the way that this is going to work. It's also based off of a parent's primary insurance amount, which is just a fancy Social Security word for full retirement age. Most of you on the call today, myself included, that is going to be 67. And what that means is that no matter how long you wait to claim or how early you claim, that only affects your benefit. Your disabled child's Social Security will always be based off of your age 67 number. They must meet the definition of disability in order to qualify. And it pays up to 50% of the parent's Social Security while the parent is alive. So if your parent is on retirement or disability, the disabled child can get up to 50%. The key is when the parent passes away, that increases to 75% of the parent's Social Security. That's the one. That's the one that I need you to be able to know about and hopefully qualify for, because that is going to make a big difference if it's likely that your child will outlive you and still be dependent. The other key is they're not going to get both. It's not SSI and SSDI. It's the greater of the two, with one caveat. If half of your parent's Social Security or 75% of your parent's Social Security is less than what SSI would pay, then you'll get the half of the 75% from your parents first, and then SSI will come in and top off the difference. So you could technically get two different amounts, two different checks, but it's never going to be more than what SSI pays. If your parents' 50 or 75% is more, then you'll stop getting SSI and you'll start getting SSDI. Let me give you an example of how this benefit works. Kalani has Down syndrome and receives $994 per month. Kalani's dad is 67 and begins taking his Social Security in the amount of $3,000 per month. Kalani is now eligible for the DAC benefit. That will pay him up to 50% of his dad's Social Security, or $1,500 per month. And because that $1,500 is more than what SSI paid him at $994, he stops getting SSI and he starts getting SSDI through the DAC benefit from his dad. And then when his dad passes away, that DAC benefit will increase to 75%, or $2,250 per month. There's your $2,000. In fact, it's more, which means even less that you, the parent, will have to figure out how to save at the end of the day. This is how DAC works. Now, I am going to throw in a key caveat, and we won't have time to go into the details of this, but I have intentional language in here that says up to. And I see someone posting in the chat, and you're exactly right. That's exactly what I'm about to say here. The key to the up to is that every person's Social Security has what's called a family maximum benefit. That essentially means that Social Security will not pay you plus any dependents on your Social Security record more than your own personal family maximum. And everyone's is different. It's based off of your earnings during your lifetime. Meaning there are some scenarios where you won't get the full 50% because perhaps you, as the primary earner and a spouse and a disabled child all need money from your Social Security. And the combined amounts of your Social Security as the parent, your spouse's Social Security from you, and a disabled child, or maybe multiple disabled children, could trigger the family maximum, resulting in less to each of you. That happens all the time. And that's something I spend a lot of time doing with my clients and planning out so that we know how to get around that, because absolutely we can fix it if we have enough time. We won't have time to go through the details on that. What I will say is in our last workshop together with United Angels, we did a very in-depth, very thorough rundown of how all of this works in practice. And I believe that's recorded on YouTube. So you're welcome to go take a look at that. I've also done workshops in the past that are recorded to our Facebook group, and you can go and watch those. That kind of breaks this down in more detail. But here's a couple threats to the disabled adult child benefit. And these are things I need you to know because I have so many parents who contact me later in life and say, I wish I knew these rules because now my child doesn't qualify and they never will because we did certain things wrong. So here are those things that some parents do wrong unknowingly, by the way. It's not like Social Security advertises this. It's frustrating, but here you go. First thing is you must prove to Social Security that your child's disability occurred before the age of 22. And I promise you that just because your child has Down syndrome or some other disability that is so visually apparent, that is not going to suffice to say, well, yeah, they were born with it. You have to prove to Social Security that they were disabled before the age of 22. That is done by having official doctor records that prove that. But the most efficient way to prove it is get your child on SSI between the ages of 18 and 22 years old. Because now they're in the system. Now Social Security knows they're disabled. Now that's there. And I'm going to throw in another little caveat. Let's say that your disabled child is trying to work after the age of 18. And they're trying their hand in the workforce. You don't know if they're going to be able to work or not. So they're working out there. And so you think, well, they're not going to qualify for SSI because they're making money. So I'm not even going to apply. Don't do that. Apply anyway. Apply knowing you're not even going to get the money. Apply so that Social Security knows you have a disabled child. Because once it's on record, it's forever on the record. That's my soapbox. Number 2, do not let your child earn. Actually, I'm going to rephrase that because I hate how that sounds. I'm not going to tell you to limit your child. Be aware that your child cannot earn more than $1,690 a month, which is the SSDI limit, after the age of 22 years old. Another caveat, even if your child's not on SSDI, even if they're on SSI and the SSI income limit is higher, your child cannot earn more than substantial gainful activity limit after the age of 22 and still hope to get the disabled adult child benefit. The reason for that is because Social Security views it as, well, you were disabled, but now you're not. Because according to Social Security, the only thing that determines if someone's disabled or not is can you work? If you can work and you're showing that you can work because you're earning more than $1,690 a month, then they say, well, maybe you were disabled, but you're not now because your earnings proved otherwise. Be very careful about the age 22 and earnings after that. And this is the official ruling. This is from congress.gov. For an individual to qualify for disability benefits, or DAC, SSA specifies that they must be continuously under a disability that began before the age of 22. SSA determines that an individual has not been continually disabled or has not been under a disability continuously that began before the age of 22 if he or she worked above the SGA level after age 22. Straight from congress.gov. That's the only place I have ever found that language. I've never found that anywhere else. And who's looking on congress.gov? Not me. So now you know. That is the key. That's the cliff you have to know about. It is very much a cliff whereupon you can either choose to step off the cliff and say, my child's going to work and forgo that benefit, or they're not. And it is a point of no return. Again, that's my soapbox. There are a few exceptions to this. If you worked beyond substantial gainful activity after the age of 22, you can claim an unsuccessful work attempt if you had fewer than 6 months of earnings above that level. And you have to be able to prove that the reason you don't have more than 6 months of earnings above that level is because of the disability. So that's a thing you can kind of work out. They also have something called impairment related work expenses, where you say, hey, because of my disability, because of the nature of it, there are going to be some work related expenses that can reduce the amount of earnings I had. So, a couple things. Like I said, as I mentioned, I really want to hit on this DAC benefit because that's the $1.2 million difference, right? This is the difference between you needing to save way more money because your child didn't qualify versus they did qualify, you knew the rules, and now it's a much less burden on you. But the question then becomes, but what if these benefits change? Or what if your loved one becomes ineligible for benefits? So I'm going to pause here because we're going to transition and we're going to start talking about different pieces. So let me take a look at our chat here. It looks like the only comment was from you, Alex, and yes, you hit it perfectly. Family maximum impact. I thought there was a comment before and maybe someone took it off, so I apologize if we didn't get to it in time. But does anyone else have any other questions about SSI, SSDI, DAC, benefits, anything else before we move on? Feel free to put it in the chat or come off mute.
Okay, I have a question.
Go for it, Amy.
You're doing that from age 67. When the parents are age 67, the DAC kicks in.
Yeah.
So, what if you die? What if the parents die before age 67?
Yeah. So I'll clarify. The DAC benefit can kick in at the sooner of a parent's disability, meaning that the parent gets SSDI, a parent passes away, or a parent claims Social Security for retirement. Any of those will trigger it. And so if a parent dies before 67, if a parent dies at 30, that could unlock it. A parent has to have Social Security, right? So they have to have worked enough to have their own Social Security, but any one of those would trigger the DAC benefit.
Okay, thank you.
Yeah, fantastic question. Any other questions, guys, on this piece? Okay, let's keep going. Feel free to drop them in the chat too. So going back to this question, what if benefits change? What if your loved one's not eligible? What if the benefits aren't enough? By the way, they're never going to be enough. I like to think of this next part of the plan as two different retirements. There's a quick question from Matt. Does a parent's net worth have anything to do with DAC? No, that's a fantastic question. Net worth has nothing to do with an individual's DAC eligibility. The only thing that affects DAC eligibility is the three criteria of SSDI: disabled, income less than $16.90 a month, and you have a parent who's disabled and you qualified. Yep, good question. After the age of 18 in general, parents' income and assets have no effect on your disabled child's income or ability to get benefits. And then left twitch, let's see. At what point does a disabled adult child need to pay taxes? Does SSI? That's a fantastic question. I love that question. If your child's only income is SSI or SSDI, it is not taxable. If your child has additional income on top of that, it may be taxable. Social Security goes in thresholds. So the more income you have, the more it's taxed. But if the only income is SSI or SSDI, it is not taxable. Great question. Let's talk about these two retirements. In order to avoid dependence on benefits, we have to supplement them with our savings. And I put the supplement in quotes because, spoiler alert, special needs trust is the street term. The legal term is a supplemental needs trust. And that is because special needs trusts are designed to be supplemental to public benefits. meaning it was never intended to cover everything. It's still expected that we have our own savings. And so the two retirements are, number one, you as the parent or caregiver, and number two, the life of your child when you're no longer here to take care of them. That's what we've got to save for. And I'll just reiterate the difference that we've talked about here, right? This is why this matters. We have to supplement. It's not going to be enough. And that's what we're going to talk about next. So let's go back to the tax return. Let's say that you got a tax return. What do you do with it? What are some things that you might do with it besides buying something really cool or going on vacation or whatever it is? You might have heard of compound interest. I think, who was it? Einstein, could have been someone else, called this the eighth wonder of the world. The average tax return in 2025 was $3,300. That's the average of what every American household got in return. Maybe you got more, maybe you got less. That's the average. What if you took that $3,300 and instead of buying the thing you want to buy or whatever it is that you decide to do, what if you invested it? Future growth. We'll talk about where to invest it, but what if you just you invested it? Stock market on average, 8 to 10% a year. After 10 years, that one-time $3,300 is $8,500. Whoop-de-doo, that's not a lot. After 20 years, it's $22,200. After 30 years, it's $57,000. After 40 years, it's $149,000. And after 50 years, that one-time $3,300 is $387,000. You took your tax return one time and you invested it. That's great. But Tanner, didn't you just tell me I need 2 or 3 or 4 or however many $1 million for my disabled loved one? Yes, I did. So let's take this a step further. Let's build a habit out of this. Instead of loaning your money to the government every year by getting a refund, what if you took $275 a month, which is the equivalent of your $3,300 tax refund? And what if instead of loaning it to the government, we dial in your taxes and you decide, I'm going to invest that. So you take your $3,300 return that you got this year, and then moving forward, you say, I'm going to invest $275 a month. After 10 years, you'll have $61,000. After 20 years, you'll have $250,000. After 30 years, you'll have over $500,000. After 40 years, you are now a millionaire. You have $1.6 million. And after 50 years, you've got $4 million. All because you took your tax return and you said, instead of loaning the government, I'm going to loan myself. I'm going to pay myself. Maybe you don't have 50 years until retirement. Maybe you don't have 50 years until death. But whatever number of years you have makes a significant difference, not only for you, but for your disabled loved one towards the first and the second retirement. That's huge. That's powerful. That's why Einstein calls it the eighth wonder of the world. Okay, but where do you put that money? Tanner, didn't you just tell me that in order to get all those benefits, my child can't have more than $2,000? Yes, I did. So how do we save for the second retirement? Someone said my screen share is off. Can you guys still see my screen? Maybe not. Oh, Kat, you can see it? Okay, okay, it looks like some people can still see it. So that had me really worried. We're gonna have to start over. Okay, I think we're good. Sorry, Sylvia, I don't know why that's not working for you. All right, we'll keep going. Where do we put this money? Where do we put this investment fund for our disabled loved ones so that they don't get disqualified from benefits? There are 3 places. We have an ABLE account, a special needs trust, and the third is we could put the money in your name as the parent and eventually let them inherit it. But it is eventually going to come into one of these 2 places. I also want to stress that none of these vehicles are places to hide or protect income. Income is income. These are places to hide assets. And hide is really the wrong word. They're designed for this, but in essence, that's what we're doing. The exceptions would be for income. You can actually put child support, pensions, and annuities that are inherited into a special needs trust. And that's the only kind of income that we can shelter. But the rest of these, this is really an asset thing. So since we're coming up on time, I'm going to fly through this part here pretty quick. But I'm going to send these slides to Sylvia, and she will send it to all of you that would like a share. And it's obviously recorded, so you can go back and watch this. An ABLE account is a tax-advantaged account that allows an individual who has a disability to have more than $2,000 and not lose their benefits. The way you become eligible, the easiest way is have SSI or Medicaid. If you have SSI or Medicaid, that means you're disabled, so you qualify. But it's not required to have SSI or Medicaid to have an ABLE account. You can self-certify. And the way you self-certify is you have a letter from a physician that says, yep, this person is disabled, and it's going to cause functional limitations over their lifetime. It used to be that the disability had to occur before the age of 26, but starting this year, they actually upped it to 46. I don't know why there's an age restriction on it at all, but that's what it is. Couple things to know about an ABLE account. Features. You can open it at any age in any state. Even if your state doesn't offer an ABLE program directly, you can use in other states. You can put up to $20,000 a year in. And when I say you, I mean anybody can put up to $20,000 a year in total. Grandma and grandpa can put money in. The disabled person can put money in. An employer can put money. Anybody who wants can put money in. But the total amount that goes into a plan in a given year is 20 grand, except if your child has a job and they are not participating in an employer retirement plan, which we don't want them to because that's an asset. If they have a job, they can put another 15,000 on top of the 20. So that's pretty cool. Funds can then grow through investing. You can either choose to keep it in FDIC insurance cash, or you can invest anywhere from conservative to growth. It's like a 401k. They give you a few options, you pick, and away you go. What's really cool is these accounts can be triple tax benefited. There are only 2 accounts in the entire world, I'm not going to say the entire world, in the entire US that have triple tax. The first is an HSA, health savings account. The second is an ABLE. Most of the world only gets an HSA. We get the second one. The reason it's triple tax is anybody who puts money into the account in the state of Utah gets a tax credit. Some states offer deductions, some states don't. In the state of Utah, we actually offer a tax credit, and that's 4.5% of whatever you put in, which is cool. The money then grows tax-free, and then the money can be taken out tax-free. So if you're following along, taxes are never paid, which is really cool. Couple other things. Withdrawals can be made anytime in any amount to pay for qualified expenses. It gives autonomy to the disabled individual while also giving oversight to the parent or guardian so that you don't have to worry about them getting taken advantage of or blowing all of their money or whatever. It often comes with a prepaid debit card, which is really cool. So it facilitates spending. If your child wants to go to school, these monies don't count towards FAFSA. And if your child has a 529, because maybe you thought they were going to go to school or grandma and grandpa set up a 529, you can actually move the money from a 529 to an ABLE account. The reason you can do that is because an ABLE account is actually technically called a 529A. So that's a really nice thing to be able to move that over. A couple things, though, to know about an ABLE account, maybe downsides. If your child's on SSI and the balance gets over $100,000, your child will no longer get SSI. If your child's not on SSI, then there is no $100,000 limit. So if they get on DAC, there's no SSI or there's no $100,000 limit. Medicaid is unaffected by the $100,000 limit, so you don't need to worry about that. In the state of Utah, the overall balance limit is $570,000. Other states have different levels and different limits, but in Utah, it's $570,000 total that can go in. If you reach that level, you have to spend down before you can put more in. The biggest drawback to an ABLE account, and this is the one that everyone talks about, is Medicaid clawback. When the account owner dies, any money left goes back to Medicaid. ABLE also is intended to pay for things that SSI and SSDI do not, which is mostly food and shelter. There are some fees with an ABLE account, but they're usually pretty small. And it's ultimately up to the account owner to keep track of expenses. It's all digitally ledgered, so it's really easy, but technically that's up to you. And if you spend money that's not qualified on a disability expense, it will be taxed and penalized. Most things are qualified, and I'll show you that. But in general, if it's determined that it wasn't qualified, then you're going to pay penalties and taxes. Second thing that I'll run you through quick is a special needs trust. So what is a special needs trust? It's a type of trust that allows a beneficiary to save or inherit assets while preserving and protecting public benefits. The reason it works is because your disabled loved one doesn't own the money. The trust does. The trust simply pays for things that your child needs. There are also a couple kinds of trusts. So you have a first-party trust. This is funded by money from the disabled person only. You might be thinking, my disabled individual doesn't have one. It doesn't have any money. Well, that can be an oops inheritance. It can be child support. It could be that annuity that we talked about inheriting. It could be all sorts of different pieces. That's what a first-party trust funds. The only person who can put money in a first-party trust is the disabled person. The second kind of trust, and actually, I'll throw this in here. First-party trusts are subject to Medicaid clawback, just like an ABLE account. So that's an important thing. The second kind of special needs trust is a third-party trust. This is funded by everybody except the person with a disability. So the person with a disability cannot put money in this. Everybody else can. This does not have Medicaid clawback, and this is the most common type of trust. When people say special needs trust, this is typically what they're referring to. And the last kind of special needs trust is a pooled trust. In reality, a pooled trust is either first or third party, but what's different is these are usually private. You set up your own, you go to the attorney and you get them. A pooled trust means you plug into somebody else's trust and you have your own account. Think of it like a 401k, right? A company, a 401k, everyone has their own account, but it's the company's plan. That's kind of the way to think about it there. Typically, we use these if the money's not a lot, and so it's not worth it to go pay an attorney to get it set up, or if we just need something really quick and easy and simple and low cost. Few considerations to keep in mind, features of a special needs trust, and then we'll wrap up. You can open a special needs trust at any age in any state. No contribution limit, no withdrawal limit. It can also hold all different kinds of assets, not just cash. It can be investments, real estate, businesses, etc. Assets can be invested for growth. They can also be set up while you're alive, or you can have your living trust or your will trigger it upon your death. And there's different strategies for that. These are taxed either at the trust tax rate, but they can also be taxed at the beneficiary tax rate, which I wish we had more time to talk about, but I've done workshops on that, so you can go watch those. Withdrawals can also be made for qualifying expenses. And as mentioned, any money remaining in a third-party trust is not subject to clawback when the account owner dies, which means it can go to anybody else that you want it to go to. A couple downsides of a special needs trust. Sometimes qualified expenses are a little bit more strict on what it can actually pay for. Taxes also have to be filed each year if that trust is earning income. And as I mentioned, the trust tax rates can be huge if we don't do it the right way. Just for context, if a special needs trust earns more than $16,000 a year, it can pay as high as 37% tax. In order for you and I to pay 37% tax, we need to be making over $750,000. So pretty crazy. There is a little standard deduction that is offered there, $5,300. Again, we don't have time to go into the details on that, but in general, like special needs trusts are not great places to grow money. They're the best places to inherit money. The trustee job is also a big job. So the person who's in charge of that trust has a lot to do. They've got to find a bank. They've got to invest the money. They've got to request distributions, keep track of expenses, know the laws, a lot to do. And it can be somewhat expensive and cumbersome to maintain. I'm going to throw this up on the screen. and you're welcome to take a picture of it if you'd like. These are the different kinds of expenses that different kinds of money can pay for. Public benefits is SSI, SSDI, ABLE, and special needs trust. In general, they're not supposed to pay the same things. And this is kind of a helpful visual just to know what they pay for and what they don't pay for. So we can talk a little bit more about that at a separate time. Just due to time, because as I mentioned at the start, there's always more content than there is time. We're going to skip through and kind of end here. I do just want to share a couple things with you for some tax savings tips. I'll throw these up here and we'll just touch on them really quick. If you go to tax withholding estimator or W-4 calculator on the IRS website, you can actually plug in your earnings from a paycheck and it will tell you if you're on track to owe or get a refund. So that's a really cool website. A lot of people ask, can you claim a dependent who is on SSI if they're over 17? And the answer is yes, you can, but only if you're providing more than 50% of their expenses. So if you're charging them $600 in rent, that's $7,200 a year. That means you need to be providing more than double that, more than $14,400, and then you can claim them as a dependent. Another tax tip is if you get caregiver comp, check and see if you're withholding tax. You may be doing so unnecessarily because a lot of that is tax-free. I mentioned the ABLE account contribution and deduction. You get 4.5% credit in the state of Utah. The biggest thing I'll harp on here, I think it's worth every penny, is just work with a professional. It's really not that expensive, a couple $100 to file your taxes. I had a client who was trying to do it on their own. And when they plugged it into TurboTax, it said they were going to owe 28 grand. They panicked. They called me and they said, do you have a better tax person? I said, yes. They were able to get them in on the 14th. They cut their tax bill down to $11,000. And they paid them $250, by the way. I think that's worth it. Putting this all together, and I'm just going to end on throwing up my contact info here. If you guys have questions, feel free to shoot me an email, reach out to me on social media, follow me on social media. I try to post almost every day, just different tips and ideas and case studies. Or if you're like, hey, I kind of need one-on-one help, you're welcome to schedule that as well. I'm going to pull up some questions from the chat here. If any of you need to run, because I know we're over time, feel free to do that. And I sure appreciate you being here. But I'm happy to hang on and answer as many questions as we can. So, Carrie, you asked, did you just say an inherited annuity could be tax-free if put into an ABLE account? Can it be an inheritance given to a parent, but directed to an ABLE account for a child? Short answer is kind of, but no. So an ABLE account can only hold cash, or it has to be funded by cash. So we couldn't put an annuity in an ABLE account, but we could certainly direct an annuity to a special needs trust. And that would likely be a first party trust if that's how that was going to end up going. I don't know if I answered your question there, but in general, it can't go into an ABLE.
If you redirect it to a special needs trust, it's still going to have the tax that you need to pay on it, correct?
Yeah, so it's a good question. So I guess the way I'll answer that is like, think about it as an IRA. What if you inherited an IRA? How does that work tax-wise? Right? Yeah. Okay. So if you inherit an IRA, IRAs have certain rules, certain income tax rules. It follows the IRA rule within the IRA, but then the money goes out of the IRA and it now lands in the trust. Once it's in the trust, now it's subject to the trust tax rules. So there's kind of two different layers of tax rules that we have to follow based on the way that the annuity is taxed or the asset is taxed, and then based on the way that the trust is taxed.
Okay.
Kind of, yeah.
Can it be if it is an IRA that is that was inherited to her father, can it be redirected to her trust? Or does it have to go to the father's trust?
So the father is the beneficiary?
Yeah.
Then whoever's the named beneficiary is who it will go to.
To the trust. Okay.
Yeah. Okay. But I mean, they could name a remainder beneficiary perhaps, and then it could eventually go to the special needs trust.
Great. Thank you.
Yeah. Nancy, you asked, just to clarify, because I was looking into this a few days ago. But in Utah, Medicaid does not count the ABLE as an asset if it goes over 100%. Yeah, Medicaid doesn't care what's in the ABLE. It's just SSI that cares about the balance. So, up to the limit, over 100 grand, up to 570, will not affect your child's Medicaid in an ABLE account. And then which of these savings vehicles is best to put excess SSI and SSDI so they don't lose Medicaid? If not receiving waivers, do we just ignore the Medicaid portion? Yeah, I love this question. I had planned to talk about it, but we just didn't have time. ABLE accounts are not designed to hold SSI funds, bottom line. Legally, they can, but they're not designed to. And the reason I say that is Social Security views that as commingling of funds. Because SSI is considered welfare, the government expects you to use the money, not save it. In reality, they could come back and say, hey, looks like you're saving all this money. Maybe we don't need to pay you quite as much because this is meant to keep you alive. This is meant for food and shelter, basic living. The way we get around that is you charge more rent. Because in reality, think about it, your child's living at home. You're not separating their expenses. You're just including it all together. And so maybe it's hard to spend that SSI money each month. The way we get around that is we say, I'm going to charge more rent to the parent. The parent can then do whatever they want with that money, including put it in the ABLE account. And then the child is on the hook for a smaller SSI portion. That's kind of a hack or a little workaround. SSDI, technically, you can put that in an ABLE account because it's an earned benefit. But Social Security still wants to know what is Social Security and what is other money. So it's just kind of burdensome to do that. And if you're not receiving a waiver, do you just ignore the Medicaid portion? Technically, yes, because only Medicaid waivers count all sources of income. Regular Medicaid, ABD Medicaid, typically will not count an increase in income with SSDI or DAC. So you can typically go above the standard Medicaid waiver income limit and not have a spend down. I think that's what you're getting at. So if you're not, I apologize. Lisa, in the last training by Utah DSPD this week, interestingly, they said that caregiver comp is not difficulty of care payments. The language used by the IRS in saying these waiver payments are not taxable. I'm not sure DSPD saying that makes a difference to the IRS. That is very interesting because I've always understood it to be that the caregiver comp is difficulty of care payment, and there's some really interesting tax strategies. So it sounds like I need to call DSPD and confirm that. Thanks for bringing that up, Lisa, because that would change a lot of things for a lot of people if that was not a difficulty of care payment. That's interesting. I think we hit the questions in the chat. Do any of you have any other questions? Feel free to come off mute or put it in the chat.
Thank you, Tanner. As always, you are very well versed in this, and we really appreciate it.
You're welcome, Carrie. I sure appreciate you having me on here. Okay. Well, like I said, I'll hang out if anyone else has last minute questions, but thank you, Sylvia. Thank you, Carrie. Thank you, United Angels, for having me on. And I'm happy to send those slide decks over as well. And you're welcome to share them with whoever wants it.
Thank you, Tanner, so much for presenting today and putting together this really helpful information. I know it's a lot of information. All of our parents that have joined us today, thank you so much for being here. Thank you for taking that step to tackle this very overwhelming but very important topic for you and your family. So thank you for joining us today for the Lunch and Learn. Thank you, Tanner, for presenting, and I'll send the recording and the slides out later today. Thank you.
Thanks, everyone. See you later.